Well, thank you very much for the introduction. Peter, Laurie, thank you very much for the support in making it possible and making the arrangements for me certainly very easy to be here today, and I am delighted to be here. As you've heard, I am a transaction services partner in KPMG. I wanted to say a little bit by way of introduction as to what that means, just so that you know, and therefore why perhaps what I have to say might bring some insight into the topic I've been given, which is a practitioner's perspective on cross-border M&A. Transaction services is part of the things that need to be done when M&A gets done. You're probably familiar with the role of the investment banks, which typically might be called corporate finance. Well, transaction services is the name which these days we call what used to be called due diligence. So transaction services does the due diligence side of M&A. We look at the businesses that our clients are acquiring to give them insight and assurance, and to let them know whether it's the deal that actually they think they're doing, and indeed that their finance providers think that they're doing. And transaction services is more than due diligence, because we get involved with our clients before they do the deal, planning the transaction, then doing the due diligence during the M&A period, and then helping them after the deal is done to do the things that they need to do to realise the value that they thought that this deal would bring. I'm very conscious that my presentation is probably, well certainly, data light. And that worries me a little bit given my audience, but I assure you I was told that what you really wanted or would value in this hour is a practitioner's perspective. And so I can tell you that I'm very confident that this stuff works in practice. I will be very interested in your view as to whether it works in theory. And maybe you can tell me about that later. As you've heard, I've spent about 10 years full-time doing M&A. And I'm going to draw on that experience and the experience of colleagues. I'm also very conscious that what I have to say by no means covers everything that could be said from a practitioner's point of view. It may seem rather selective. I've tried to be selective with the things that I think are really important when we're advising clients. And I have tried to bring in some cross-border aspects to what I have to say. It's worth me saying as well that as you know, KPMG, of course, are one of 4 very big accounting firms in the world. We all offer a global service to our clients, but we are all, in fact, structured as different national practices around the world. KPMG has just merged its UK and German practices. And so that's a sort of cross-border deal within M&A. And some of the things that I say I will be able to illustrate actually by our own experience within the KPMG world of drawing on what I've seen as we've tried to merge as one legal entity and one managed business our German and UK businesses. This is what I plan to do in the time that we have. I'll make a few further words of introduction, and then I plan to split what I have to say broadly into 2 main areas. I'd like to give you some insight and experience that I have from working with clients who are buying businesses, often cross-border. And then I'll switch and I'll talk about a few experiences of working with clients who are selling businesses cross-border. So that may be that the parent is based in one country and the subsidiary or the business that they're selling is based elsewhere, or maybe just that the bidder is based elsewhere. But we'll talk about the sell side. And then, because there are particular issues in emerging markets, I'll just dwell on emerging markets. If we have time, see how we go. I have a few points to make specific to an example from the emerging markets, and then I'll wrap up with some concluding comments. So that's broadly the structure: buy side, sell side, and then an example from emerging markets. It's worth me saying that I think when I was asked to speak on cross-border M&A, and I thought, well, what are the issues specific to a cross-border deal as opposed to any other deal? The similarities between cross-border deal and other, perhaps large domestic deals are many, and actually the differences are not that great. What cross-border does, though, is it exaggerates and it amplifies, if you like, makes more difficult achieving the things that you have to do to get a successful deal. But those things are the same things. Whether it's a domestic deal or a cross-border deal, what you have to do to get the value out of the deal are probably the same things, but cross-border makes it more difficult. I hope that doesn't oversimplify it, but I think there is a truth in that. When a deal comes into us, my mind doesn't suddenly say, is this cross-border or not? Our thinking is the same, and that's a point I might just make a couple of times as we go through. I also would like to just perhaps draw your attention to the fact that due diligence has changed over the years. And to find a problem in the valuation of stock or provisioning, and to be able to say, no, there's a hole in this balance sheet, or there's a problem with this balance sheet, and my client could then reduce the price of the business that they were acquiring. And they would reduce the price by a number that was many, many times my fee, and I had justified my place at the table, and everybody was happy. And that's what due diligence was like 10 years ago. That was success. And that's completely changed now. Certainly, if there's a hole in the balance sheet, our client needs to know. But particularly over the last 5 or so years, virtually any decent asset or business that's being sold is being sold in an auction. And most of those auctions have had private equity bidders in the auction. And if my only approach to due diligence was to kick the balance sheet, to criticise the accounting policies and provisions, and to offer my client the bullets to go and get a price chip, all I was actually giving him was an early exit from the auction. And that was never good enough. That was never success. Because what has happened in the auction, the competitive environment that auctions and private equity have created, is that clients now want from us help in finding the upsides in the business that they're looking at. Clients want us to challenge the base case of the management of the company that they're about to acquire and say, how can we run this business better? What are the upside potentials in this business? And private equity particularly have driven this very hard and have led the way. And this is one of the reasons why the big surprise that we see so often is you might see a large deal and you see private equity houses outbidding corporate bidders, when corporate bidders have all the advantages of synergies. And you say to yourself, how can that possibly be the case that private equity can outbid the obvious trade bidder or strategic buyer? And the reason is because of this mindset of private equity that they are an active investor who wants to drive up the performance of the business that they're about to acquire, and they start factoring some of that into the price that they're willing to pay. And so the demands of what we do in transaction services now are completely different and much more exciting in terms of trying to help your clients see where value can be created if they do this deal. There are exceptions to clients only being interested in where the value is and really finding value in the due diligence that we do. I recall a meeting where a Far Eastern investor was looking to acquire a business in the UK. I was presenting the findings, the exciting findings of our due diligence, and I was looking across the table at our client from the Far East, at frankly a disinterested audience. And at a break in the meeting, one of their other advisors came alongside me and said, David, no matter what you say today, they're going to do this deal. Their bonuses depend on doing this deal. And so we stopped wasting each other's time and we wrapped the meeting up quite quickly and the deal got done. That is the exception. That is the exception. Most of our clients genuinely are wanting to use the transaction services approach to find out where value is in the businesses that they are acquiring. Okay, let me now turn to the buy side, give you some examples and stories from the buy side. You will probably know the literature better than I do. There's lots of it. Literature that basically says that the majority of mergers and acquisitions do not add shareholder value. We published something in 2006. It probably looked back at deals through to end of 2004, maybe 2005, that said only 31% of the deals that we surveyed added shareholder value. We're on the verge of publishing something next month. I saw the provisional numbers yesterday, deals up to the end of 2006. The deals that we looked at, only 25% of deals created shareholder value. Coincidentally, I think KPMG's market share is about 25% actually, but that's a by-the-by point. 25% of deals we're about to say is all that added shareholder value. I think one of the drivers in this latest survey is the rising price that people are paying for deals that makes the hurdle to add shareholder value even higher. In the 2006 survey, which was called the morning after, all the excitement of having done the deal, you've tasted the champagne, you've signed the deal, you wake up the following morning, the morning after the deal, and it's all still to do. And our survey was called the morning after, and it looked at the challenges that companies face when they've actually signed on the dotted line. And in that survey, companies said that the single largest challenge that they faced in realizing the value that they sought from the acquisition was integrating two large complex businesses. That was integrating the business, their own and the business that they bought, was the single biggest challenge that they faced. And a cross-border deal, sort of intuitively and obviously, is even more complicated in integrating. I just want to dwell for a few moments on what we see as the four stages of integrating two complex businesses. Firstly, we have synergy evaluation. Here's the deal closing. So these first two phases are before the deal actually gets done. So the first thing that the client has to do is think about the synergies that they see in this deal. And that allows them to say, I understand where the value drivers are in this deal. Secondly, before the deal gets done, there is this pre-completion planning. And this is enabling them to say to themselves, I am ready to take control on day one. And the third area of planning is what we sometimes call the 100-day planning. That allows them to say, I know what I will change, and in this 100 days I can see how it will work, and I can see benefits already flowing through. And then there's a fourth phase of integration planning, which is that I can see further benefits that will flow through in the future. And if integration is the number one issue, it's always the number one issue in a cross-border deal. Because a cross-border simply amplifies and exaggerates, makes more significant what is actually the biggest issue and the biggest issues in all deals anyway. Let me just look at the first two. I'm not going to go through all four phases. I'd like to just concentrate on the synergies evaluation phase, and then just a word or two about pre-completion planning. The synergies evaluation is absolutely critical. Our research tells us that, I'm not sure you can see this because it's down here in red, but on average in our 2006 morning after survey, which is available on the KPMG website, but in the morning after survey we found that on average bidders paid away 43% of the synergies in the purchase price. So they thought to themselves, what do we as a buyer bring to this deal by way of synergies with this target company? They evaluate that and they factor in 43% on average into the price that they were willing to pay. And of course, in an auction situation, you're probably paying a premium over the standalone valuation of the business anyway. You look at the standalone valuation. You add a premium because you're in an auction, it's a competitive situation and you want to win. And you can add probably on the top of that a small slither of professional fees. And when you think about the total price that you've paid to acquire this business, you wake up the morning after and the business is still only worth that standalone value. And you've got it all to do. You've got it all to do. And if you've paid away 43% of what you think you can do, then you've got an awful lot to do before you even start recovering the price that you've paid for the business. Sometimes we are asked to, particularly on public deals, listed companies acquiring listed companies, sometimes the acquiring business makes a statement to the capital markets about what synergies it sees in the deal. And sometimes the accountant, usually the auditor of the target of the acquiring business, is required to give either a public, not usually a public, but sometimes a public and often a private comfort letter saying that the company's statement about the synergies that they see in the deal is reasonable, made after due and careful inquiry. And these are the sorts of things that we would expect a company to have done if we were willing to sign off that their statement about the synergies available to them in a deal was properly made. I'm not going to go through them all. Clear integration principles in the planning. We would say that if the synergies number that they disclose publicly could be said to be robust, they're likely to have done these 8 things. That's likely to have started with a clear statement of what the integration principles are. Those can be quite soft issues or hard issues. So, for example, it could be that we will integrate these businesses, and a guiding principle will be that we will always put the best person for the job in the job. So in terms of selecting the management team, for example, for the enlarged business, they will select the right person for the job. That is much more easily said than done because of the politics that often follow a merger. These things, of course, are not public, but these are the sorts of things that we would expect a client to have gone through if they want us to sign off on the synergies number that they've given.
Can I ask you a question?
Please.
Okay to ask you?
Yeah.
Do you, given how crucial the people issues are to the success, do they do any systematic analysis? Because I know there are human resource companies that have expertise to do analysis of cultures and pay practices and so on. And they at one point were thinking of a business of going in and assessing the fit of 2 companies. Is that done yet in terms of really analyzing, is this going to work, is it achievable? Since it is about people issues, that would strike me as an important analysis to be done before the deal gets completed. Is that happening?
Well, it is happening. It's something I'll come on to. It's absolutely something that we do. I'll try and illustrate to you a little bit about how we do it and what the output of it looks like and how companies can use it. But you're absolutely right that integration, it's very easy for me to say, well, actually the biggest issue, of course, of integration is simply cultural issues and people issues. But actually you've got to deal with them by way of a thoroughly thought through integration plan. At this stage, I'm just talking about the synergies number that you're saying to the markets is the value you see in the deal. If you're going to say that publicly, the markets often want us to report on it, and this is what we expect to see. One of the issues, just at the bottom here, avoiding conservatism cubed. What you find is that you've acquired the company, you've got the management of the business that you've acquired, they give you a set of forecasts as to what's achievable in the business. They know that next year's bonus probably depends on it, so they're fairly conservatively stated. They then perhaps get sent up to the integration team, and they're thinking that their bonuses depend on making sure that the integration works, so they just knock off a little bit to make sure that it's conservative and that it's in the bag. And then it goes up to the group finance director, who before he goes to the group chief exec to tell him what the synergies number or the combined value of this set of forecasts is, he knocks off a little bit as well. And in the corporate world, because people's bonuses often depend on meeting these forecasts, the possibility of you finding that in the process you've got conservatism cubed is very real. Interestingly, that's one of the mindsets that's absent in private equity. Private equity are quite different about that. Their bonuses don't depend on that. Their bonuses depend on the exit. And so they're more inclined to talk up the case. They're more inclined to say, come on guys, we're going to be rich. What we need to be doing is stretch for that really big target. Let's go for that target. Let's think about everything we need for that really big number. And in private equity forecasts, you're not likely to get that conservatism cubed number. It's just a difference between PE culture and corporate culture. I better move on a little bit, actually. I'm not going to dwell on this because time is against me. So, but this is just saying that you're planning for day one. And actually, planning is the key. As I've just touched on, planning is the key. A detailed integration plan that is more difficult, often cross-border, not least because of obvious difficulties like different time zones, just the distance of management. Over dinner last night, Peter was just mentioning to us, you know, that it's been much more difficult to arrange this conference for you in the UK than in the US. It's not that he's had to do different things to arrange the conference in the UK rather than the US. It's just more difficult to arrange it here than at home. And it's a bit the same on a cross-border integration. It's not that you're arranging different things or trying to achieve different things. It's just obviously more difficult. And so you have to plan. I want to give you a sort of light-hearted look at how 4 different countries approach planning. I'm not trying to cause any offence to anybody in the room. It's a light-hearted look at how 4 different countries might approach planning. So the German approach to planning is that we plan, and we plan because somebody is going to want to measure us and tell us how well we've done. So the plan had better be clear on how we're going to be measured. And then we implement, and then we can evaluate and be measured, and we all know where we stand. The Japanese way is to spend a lot more time actually planning. Is this the best plan that we can come up with? When we're happy that it's the best plan that we can come up with, then we'll start implementing. And then, quite soon, we'll start improving the plan because we can see how we can make it better. Then we come on to the American way. Where we just skip the planning and we just do it and get on with the implementation. And then we move to the British way, which is from the very beginning, be careful to make sure you're negotiating. Don't agree to any outcomes until the end is in sight and we know what success looks like, and only then agree to what success looks like when the end is already in sight. Keep negotiating. That's the British way. Now, the serious point actually here is invest time in clarifying the definition and their meanings. So it's one thing for me to say to my UK colleagues in our KPMG merger that we want a plan. It'll be back of a fag packet, we broadly know where we're going, state the vision. But for my German colleagues, that is not enough. Firstly, it has to be agreed face-to-face in a formal meeting before it can possibly be judged to be the agreed plan. So cultural differences around things like planning and the definition of what planning looks like and feels like can be very marked. So that's integration, 4 phases of integration, the core of which is about planning. 3 very quick points before I move off by side, just to say, and I'm not going to say everything I was going to say on these slides, but synergies is sometimes characterized as saying 1 + 1 = 3. Well, of course, before 1 + 1 = 3, 1 + 1 must equal 2. And it's very, very important that the integration is not so all-consuming that people lose sight of the fact that the business has to carry on. And that actually one of the ways that management get distracted is you have integration tourism. So you have people finding all sorts of reasons to travel to parts of the newly acquired business to hold their meetings, rather than actually running the business, which is their day job. I'll move on. Sorry. Again, from our survey, one of the things that we found is that companies found that it took longer for them to get control of the business that they had acquired, longer than they had expected. And so for 32% of the respondents, it took them over a year or up to a year before they felt that they had control of the business. And we're about to publish a survey which is called Living with the Consequences of having done the deal. Living with the Consequences, this is the survey that will come out next month. And it's absolutely about the things that companies have to do to get control of the business that you've acquired. I'll dwell on this because these are the people issues. This is the slide I showed you before. The top issue was the integration of 2 complex businesses. The next 2 issues are both essentially people-related issues. Specifically dealing with different cultures, and then secondly just dealing with people and emotion and HR issues. With the next 2 single biggest issues that people found as the problem of integrating businesses. Now, what we do is, in addressing the cultural issues, through basically a process of systematic Q&A with management, we try and find out what the different cultures of the 2 organisations are. And we highlight where those cultures are very different. And you can see on the slide the sorts of things that we're trying to use to define whether cultures are different. So in one particular organisation, is it Are you rewarded for taking initiative and being the individual who makes things happen? Whereas in another organisation, you don't do anything unless you do it by consensus and after consultation. In one culture, it might be very centralised. In another, it might be very decentralised. And you can see other... farther down, is it a culture where open communication is encouraged? So you can go into a meeting and you can discuss ideas openly and think things through openly. Or is your culture much more a need to know? Now, nobody's saying either is right or wrong, but when you put two organisations together that are very different, then realising the value that you thought there was going to be in a transaction can become more difficult. The output of that, I know you can't read this is just to show you actually, that culture comparison was done between KPMG UK and KPMG Germany, and this guidance was issued to the partners in both countries as to how we might think about the cultural differences, as how we might choose to modify our behaviour, not that either was right or wrong, but how we might choose to modify our behaviour so that we got along and had common goals and objectives. So from a piece of analysis that tried to quantify where cultures were on different scales, we then tried to give our clients some practical guidance as to how in the post-acquisition period you might encourage your people to deal with. I'm going to move it on, you're too interested in that. Okay, those are some thoughts on the buy side. We see this. We've seen these things very often. One of the buy side deals that we advised on was Toshiba's acquisition of Westinghouse. Westinghouse being the nuclear power station designer, builder, consultant. Toshiba paid $5.4 billion for Westinghouse. I think the market's expectation was that that asset would probably go for a number beginning with 3. Toshiba paid 5.4 billion. That was largely obviously about the belief in a nuclear renaissance, in terms of many countries beginning to turn to nuclear as a solution to CO2, etc. Or carbon emissions, sorry, and also synergies. They saw big technical and engineering synergies in that deal. And a lot of what I've said about the integration planning and being able to make that happen was what we were doing with Toshiba. Right, let me move on to sell side. Again, just let me give you a couple of statistics on sell side. In 2004, we did a piece of research that said 30% of vendors, 30% of those people selling their business, found themselves facing a 20% price chip. They got 20% less for their business than they thought they were going to get. Last year, we published a piece of research that said nearly half of corporates felt that on their last disposal, they didn't realise full value. And nearly a quarter of private equity houses felt the same about their last disposal. I want to just talk to you about a large cross-border deal that we were involved in. This was advising Ford Motor Company on this year's sale of the Jaguar Land Rover businesses to Tata, the Indian conglomerate. The JLR business, just a very quick summary, you've got the Jaguar, iconic British brand, 71,000 cars roughly a year, 3 billion of sales, 800 dealerships, 64 marketplaces. Having come from making significant losses, had turned the corner and was beginning to make profits. And of course Land Rover, which includes the Range Rover brand, 3 times bigger than Jaguar, nearly 200,000 cars, 3 times the sales, nearly 1,300 dealerships in 140 markets near enough, 5 models, and had been in profits for a couple of years. Jaguar Land Rover was part of the Ford Prestige car group, and it was heavily integrated with the Ford business on a whole range of issues, and it had to be sold. And of course in selling it, it had to be deliverable. You had to actually be able to hand it over, as it were, to the Indians, to Tata, and therefore it had to be separable from the Ford group, and that was a huge issue. We've made a short video actually which we've sent to clients to show them what we did for Ford. I thought by way of just breaking up my presentation and giving you a little insight into what we did for Ford, I'd just show you this as just a 4.5 minute video, and then I'll make a few points on the back of the video, and specifically about how you create value on the sell side. But let's see this video. I know that sounds a bit salesy, and of course it was prepared for sales purposes. It was prepared to be sent to clients, but I thought I'd show it to you, not for the sales messages particularly, but so you can see the sort of practical help that clients need. You know, the Ford Motor Company is a huge enterprise, and it needed a lot of practical help to actually identify firstly the points that needed separating, and then actually to put it into practice and to deal with the whole process of articulating the evidence for the projections for the JLR business to bidders, and that's what we did. So it's for that reason that I showed it to you. And actually the cross-border issues are perhaps obvious, because you know, you've got Ford in the US, parented in the US, JLR basically based in the UK, operating in many countries in the world, bought by an Indian acquirer. I know that the KPMG team on the project was drawn from 13 different countries, or you know, working in 13 different countries to be able to give the advice that we gave to Ford. What was the approach that Ford took to that separation? Firstly, they needed to create and understand the value that they expected to create from this deal. Secondly, they needed to contain that value, having thought what it was worth. How could they actually make sure that that didn't not get valued in the same way by the bidder? And thirdly, they needed to capture the value in the process. Let me be just very quick and say a few points about what we did here in terms of, or what Ford did in terms of creating value. How do you make sure that the potential of the business is seen? Well, I'm going to skip through down to here, really down to the developing and substantiating a business plan. This goes back to the point that I made at the beginning of the presentation about due diligence having changed over the years, and people being willing to see and value the upside potential of a business. So a lot of the work that we were challenging and encouraging Ford to do was to value the upside of the business. As I said at the beginning of this little bit, these businesses had only recently returned to profit. The sustainability of that profit and the future growth potential was a key objective for Ford in being able to demonstrate that to bidders, and that's part of what we helped them to do. The point above that is actually preparing the standalone financials. The business that was actually bought, the boundary around the business that was bought, had never been reported as a separate entity before. So those carve-out financial statements was an important part of the preparatory work, and you know, that was not a straightforward task, because you've got all the issues of stranded costs and standalone costs and apportioning overheads, etc., had to be thought through. And the thing in an auction situation, and the thing is when you're selling a business, where you leave uncertainty, the bidder never gives the vendor the benefit of the doubt. The bidder will always assume the worst case. And so therefore the vendor has to spend the time in preparation narrowing down the possible range that's left for the bidder to worry about. In containing value, making sure that the bidder saw things the way that the vendor saw it, the main tool here, having prepared all of the data, was that a vendor due diligence report was prepared. Vendor due diligence is accepted in most M&A worlds. Vendor due diligence, for those of you who don't know, is rather than the buyer doing their own due diligence, the vendor commissions an independent piece of due diligence and makes it available to the bidder. And the bidder can rely on that due diligence. And a separate team at KPMG, aside from the team who did all the advisory work to Ford, wrote a due diligence report that Tata are now relying on. And if it goes wrong, you know, Tata will sue KPMG for because of the VDD reports. It's one of the ways in which Ford sought to make sure that there was full disclosure of everything that they knew Tata would need to know. And it also was a way of making sure that all bidders, no matter which country they were bidding from, had the same quality and analysis of information, so that the actual bids that they received were comparable because they were relying on the same data. And capturing value, well, one of the ways in which value can leak is in the actual contract that you sign and the whole completion accounts mechanism, and there are lots of accounting issues in that, definitions of what is cash, what is debt, what is working capital. All of those things need to be thought through ahead of drafting and designing your sale and purchase agreement. I have an example in my mind of two European companies. One was buying, one was selling. They were actually selling a Californian-based subsidiary, and the buyer had negotiated hard with the seller. Excuse me. The buyer had negotiated hard with the seller and felt actually that they'd taken the negotiations as far as they could go without losing the deal. One of the things that they had realised in due diligence is that the subsidiary company in California didn't actually comply with the European group accounting policies on depreciation. And what they decided to do was negotiate that the sale and purchase agreement and the completion accounts, one of the rules for preparing the completion accounts had to be that the completion accounts will be prepared under the group accounting policies. You wouldn't think that was contentious for the vendor. The vendor would be happy to say, yes, we're happy that the accounts are prepared under our own accounting policies. And then when the deal got done and the completion accounts got prepared, the purchaser was able to seek an adjustment for depreciation to the net asset. There was a net asset threshold, by insisting that the accounts were adjusted because the subsidiary didn't comply with group accounting policies. And of course there was nothing that the vendor group could do about that. And the point I'm making here is, and this really is a cross-border issue, is that the distance of a subsidiary away from the parent company can become an issue. What happened in this particular deal was that there came a point where basically the purchaser knew more about the subsidiary than the parent company that owned it. The parent company who owned it thought it wasn't risky to say, yeah, we'll have the completion accounts prepared on our own accounting policies. And this happens time and time again, where businesses that are being sold without sort of pre-sale review by the parent. And there comes a point in the deal where there's a tipping point and the buyer knows more about it than the seller. Another example of where that distance of the subsidiary can become an issue. I was acting for a client last 2006, UK listed PLC, selling a French subsidiary. It had originally owned, the UK company had initially owned 49%, and then it acquired the remaining 51%. That transition to 100% wasn't a big earthquake because of course they already thought they knew quite a lot about the business at 49%, but they actually ended up owning 100%. Then 7 or 8 years later they sold the French subsidiary. Actually the French subsidiary had not been a problem business. It had always met its targets, it had always generated cash, it had always met its budgets. When we went in there to look at the subsidiary that was being sold, what we realised was that the reason that they always met their budgets and they always generated cash is that their budgets were so conservatively prepared because actually they weren't considered a problem child. The UK parent basically left the French alone to run it. But the set of projections that French management had put together, they were no basis for the parent company to sell the business on if they wanted to maximise value. But they had left it too late, and there really wasn't time in the process for the parent to adjust the French forecasts. And that distance, that lack of familiarity of a parent company with its subsidiary is quite frequent. It happens more often than you would imagine.
Another 3-4 minutes?
3 or 4 minutes. I did say at the beginning I wasn't sure how much I would say on emerging markets, so I won't say very much. Let me just say again that in emerging markets a lot of these issues are amplified even more. here are one or two slides that we've used in a presentation time and again where we're talking to clients who might invest in China. One thing I haven't said, you might have noticed it, but I tended to focus early on in my discussion about synergies and new strategies, the things that create value. Of course, in due diligence, you have to focus on the initial value of the business as well, the core business, not just the new things that are going to be done, but looking at this core business. And something that Ken was saying earlier, I totally agreed with, that actually you should never work with unadjusted numbers. And in due diligence, we never work with unadjusted numbers. You're constantly adjusting the numbers for the sorts of list of one-off items that Ken put up on one of his slides earlier. Those are the sorts of things where we're genuinely trying to understand the underlying performance of the business. And that's at the heart of any due diligence. And in an emerging economy like China, where the reliability of the financial information is not always assured, then it's a much more daunting task. And I don't think I'm going to comment on many of these issues. You will have a statutory role for a valuer, for example, in China, and the basis on which they value a business would not be any valuation method that you would probably recognise. And again, you have to be upfront about that. You have to understand what are the assumptions, and you have to challenge those assumptions and really dig it. These markets are very different, and you need advisors who know the market. But I don't think I've really got time to go through any of those, so I won't. As I said, the issues are all about why are you doing the deal? Why do you think you can create shareholder value from either buying this business or selling this business? Why do you think that is the value that you can create? And to design whether it's your integration plan or your separation and sale plan, to be very, very clear and provide evidence on where that value is and how it can be accessed in practical terms. That's what we do. And those are the same issues in a domestic deal or a cross-border deal, but a cross-border deal amplifies the difficulty, exaggerates and makes more difficult realising that valuation. And at that point, I will stop. Thank you very much.
Laurie.
Hi, could you speak briefly about how you both advised Ford on the sell side, and yet you also did the due diligence, and how did the bidders perceive that due diligence, given that you're also advising Ford on the sale? It seems like a conflict of interest.
They have a microphone, so I don't need to repeat it anymore.
Okay, well thanks. Yeah, so the question is that we've advised Ford in helping them on the tactics and the preparation for the sale, and we've also written the vendor due diligence on which the buyer will rely. And the essential way in which we've done that is that we have had completely separate teams. Essentially, we've had Chinese walls between the sell-side assistants, as we would call it, the sell-side assistants team, which was Steve Muntz and his team, in helping them think through all the separation points and think through what the cost of separation would be and narrow that down rather than leave a wide range so that bidders don't take the highest cost rather than the lowest cost. All of that advisory work for Ford we would call sell-side assistants. And then when that work is done, and when we're able to say to the company, yeah, we think you're now ready for due diligence, a completely separate team behind a Chinese wall is brought in and does the vendor due diligence. And that's the way the market accepts vendor due diligence. And the thing about the vendor due diligence is that we have to explain to bidders that degree of separation. They want to know how we've actually done it in effect. And of course, then they look at the contract, because when we send them the vendor due diligence, we also send them, essentially we send them a contract which says, here's the vendor due diligence, read it, make your bid on the basis of it, and if you become the final bidder, you can rely on it. And that's the way it is. And some companies have specifically said to me, when I've talked to them on the sell side and tried to persuade them to use KPMG, let's say, to do vendor due diligence, they say, no, we won't even commission vendor due diligence because we would never buy on the basis of vendor due diligence, because we always think that vendor due diligence, the team is in the pocket of the vendor. I can tell you from practice of writing the VDD, you don't feel in the pocket of the vendor. You absolutely feel on risk to the purchaser. But some companies take that view. Actually, in practice, if they take that view, essentially they don't manage to make many acquisitions. Because certainly in the UK and in Europe, less so in the US, but certainly in the UK and in Europe in recent years, vendor due diligence has been the norm. It's all part of that auction process that I said has become so dominant in the UK. But I know it doesn't look pretty, but that's how it works.
I guess I'm thinking Sarbanes, obviously, in the US, it seems.
Yes. So you obviously come to a number of very valuable insights as part of the due diligence process, and accountants require firms to prepare purchase price allocations, which are implicitly like a justification of the purchase price. This is what we paid, and these are all the resources that we're getting. I'm wondering how influential the insights you get are, or how linked your work is with the preparation of purchase price allocations. Are they two separate processes? And then more generally, how the work you do influences the overall communication strategy around the unveiling of these acquisitions once they're agreed to and they're formally announced, and getting buy-in from investors and other stakeholders.
Okay.
So the purchase price allocations is one specific form of communication about the merger, and then the more generally communications.
Yeah. Well, the purchase price allocation work would be done, in KPMG terms, it would be done by a different team, but actually our work, any work that we had done that gained insight into the target business, the due diligence reports that we would have written, absolutely would be available to of course the company and the auditors in deciding on the PPA, the purchase price allocation. And it's a sort of different set of judgments. It's not really written, the due diligence isn't written with that in mind, but it is always used by the PPA accountants to discuss with the client how they will allocate the purchase price across the...
Yeah, I wanted to get a sense of whether this purchase price allocation really is reflective of how acquirers arrive at the purchase price, or really if it is more of an ex post exercise that's really de-linked or decoupled from the work you do, which sounds more influential in determining the purchase price.
No, I would say there is a close link, that our due diligence work would inform and not be something that they have to work round, but rather something that they work with in determining the PPA. And on the wider point, about how our work influences what may be communicated to the capital markets, was that essentially the question?
Yes.
One of the things I touched on was the synergies point. So in public reporting of synergies, absolutely on the integration buy-side work that I was referring to, those 8 things would be things that we would expect the company to do if they wanted us to report publicly on a synergies number. Perhaps more a new point, a broader point, is that we started talking to clients about the statistics that say 31% or 25% of deals, whatever it is, don't create value. If you're the non-executive director on a board and you're sitting at a board meeting and the finance director or the chief exec propose a major acquisition, then surely one of the roles of the board is to say, have we got the controls in place to manage the risk of doing M&A? Because actually M&A is a huge risk for a company. The experience shows that so many deals don't add value. And one of the things that we've been talking to clients about is whether more companies ought to be making fuller disclosure to the markets as to what their M&A process is, and actually reassuring the market that they've got a world-class or best-in-class approach to mergers and acquisitions.
A lot of what you talked about dealt with sort of sharing or having access, either if you were on the buy side, having access to information from the sell side, or vice versa. What do you do in hostile situations or unwelcome bids?
Well, in a hostile bid or a public bid where you actually don't often have access to the target company, what we do there is we basically work with our acquiring client to do as much analysis as we can on the basis of publicly available information. Usually a public-to-public bid, in the UK, a public-to-public bid, there will be some exchange of information. It won't be full access. It might be a stretch to call it limited access, but you will probably get some information. The problem is that if a public company gives information to one bidder, under the city rules, if a bona fide bidder comes along, you have to give it to them as well. So that's why companies are so careful. And so, in essence, what we're doing with clients is challenging our buy-side client all the time as to where is the value that you think there is in this deal. Let's think together about the synergies on the basis of publicly available information and, of course, the detailed knowledge of your own business and what you think you know about the target business. So synergies is one piece of work that we can do. And then the other value areas that they see, what we try to help clients do is to hone down their information request list of the target public company to the very, very specific things that will help them determine whether the value assumptions that they're making are indeed true. It's very easy to go and say, we'd like the management accounts for the last 36 or 48 months. And we don't know quite what we'll do with them, but when we get them, we'll do whatever analysis we can with them. And what you need to do is be much more specific about why you think this is a good deal, and if that assumption is true, what information would validate it, and ask for that information. And you can get information in public bids, but it has to be well justified. I mean, I'm working on a public bid at the moment, and in fact, last night our team was going through exactly this strategy of how can we ask for this information in a way that will be useful to us, because what we're going to do with this business, but actually wouldn't be threatening for the target company, because if they gave it out to somebody else in this business, to another competitor, actually the information we've asked for in that way would be of no use to anybody else. So it's a bit cat and mouse, but you're right, it's a difficult one.
You mentioned that many of these bidding situations involve rivalry between alternative bidders. Could you say anything about, to what extent do you profile the alternative bidders? Because in deciding what you're going to bid, you have to look at, well, what are the other guys thinking?
Absolutely.
And maybe even to some extent you might want to tell the other guys that their thinking isn't very smart, to try and put them off bidding or try and put them off bidding too high. So how do you play that game?
Well, you're absolutely right that there is a piece of work to be done on both the buy side and the sell side, actually, about evaluating bidders. If you're bidding for a business, we have found that many corporate clients are fascinated for good reason about what private equity, for example, will pay for a business. So one of the things that we do when we're advising a corporate client in an auction situation is we try and do a piece of analysis work for them as to how a private equity company would look at the target business. And we try to say to our corporate client, well, you know, this is where, if we were acting for a Premier or a Cinven or a KKR, you know, these are the sorts of prices that they will be putting on this business for these sorts of reasons, because they will probably be willing to see these sorts of upsides. And so we absolutely advise our corporate clients, for example, on the PE perspective. On the sell side, another piece of work comes to my mind where basically we did a piece of work for a vendor. They were selling a substantial business. We knew there would be competitive tension. We knew that both private equity and corporates would bid. We knew that there would be 3 particular corporates who would bid for this business. And we did a piece of work for our sell-side client to evaluate for them what we thought the synergies would be for these 3 different corporates. There were 3 different numbers. So the synergies number is obviously different depending on where you're coming from as a bidder. And what we wanted our sell-side client to do was to be able to drive the synergies discussion with the bidder, rather than the bidder being able to say, well, we see synergies of 100 million. We wanted our client to be able to laugh loudly at that point and be able to say, of course, there's at least 200 million, or whatever the numbers would be. So you're right, we do that bidder evaluation. And tactically, you need to know where you think the other bids will be.
So you mentioned a little bit about the difference in, like, saying due diligence and the evolution in terms of incorporating the synergies and the private equity playing a role on this change. And then you talk about, like, say, many bids not generating value. And my question, follow-ups to that question there, do you see a different success rate between PE being the acquirer and the corporations? And if so, what do you think is the reason for that?
The question is whether there's a difference in making a success of M&A for corporates or for PE. Certainly on the sell side, let me just start there. On the sell side, we would say yes. Private equity houses, generally speaking, are better at realising the potential when selling a business. So it was 48% of corporates felt they hadn't, only 24% of PE felt they hadn't got full value for their last disposals. Because private equity are very professional, they're serial deal doers. When they've bought a business, their strategy is about how they get out at a premium. And they are thinking all the time about preparing their business for sale, not just financial engineering it, but trying to improve the business so that they will exit it at greater value. They're much more focused on that, not least because they are much more bonused on that than corporates. On the buy side, I'm trying to bring to mind some sort of evidence that would allow me to say that one or other was better. I can't think of analysis that we've done. I think that private equity do some things particularly well on the buy side as well. So, for example, one of the things that they do is that they drive down working capital much more effectively than many corporates do. And so one of the things that we quite often do for corporates is that if they think they're going to be acquired by a private equity house, we go and talk to the management team of the corporate to say what life under private equity will be like. And one of the things that life under private equity will be like is that cash will be king in a way in which you never thought it could be. You know, you thought cash was king in your corporate empire, but it will be king in an altogether new way under private equity. So, but I don't. I mean, private equity win more auctions for reasons that I've said. John Moulton, head of Alchemy Private Equity, you know, he's very focused on the fact that you actually never know whether you've done a good deal on the buy side. You only ever know whether you've done a good deal when you exit. I mean, anybody... We sold a business, I won't say which it was, we helped a client sell a business. And the price that our client got was a phenomenal price. Way, way more than anybody expected the business to sell for. And one of the trade magazines here in the UK gave the Finance Director of the Year award to the acquiring finance director. And we just laughed, really. We thought, how on earth will they ever, how on earth can they know now that he is the finance director of the year? Okay, he's won this deal in an auction, but it looks as if he's paid a fantastically high price. Surely the FD of the year is the sell-side finance director who sold his business at an unbelievably high price. So it's a strange thing. I think private equity better on the sell side, always difficult to tell on the buy side.
We've got to stop here for want of time. So thank you very much.